Good morning, everyone. Online, am I audible enough? So the question that we all have discussed yesterday sessions, you remember a few OTQ questions. I think that would be tested, section A most probably, right? Very rarely that I have seen from your past paper, the area what we discussed yesterday sessions under what analytical tools, apart from the learning curve, that has been tested by in your section B or C. Very less probability. I don't know because I can't. Otherwise, right after the exam, you will come and ask from me. You said, but it won't be tested where in the section B and C. But we have got the questions. But experience I'm sharing with you. Very less probability. But the area that we are discussing today's sessions, but the small area, forecasting. Right after that, we'll be starting a very, very important topic, risk and uncertainty. No paper will be designed without what? Risk and uncertainty. There should be a question from that, risk and uncertainty. But for these area, correlations, regression equations, and forecasting, I would say section A or section B, not section C. But make sure learning curve, anywhere it will be tested. There's a chance. Sanjana, have you written the answer for the theory-based question with regard to the zero-based budgeting? And there's another questions about what participative budgeting and all. Morning, everyone. Why, Sanjana? Because you should do it because you are having exam on this March. For others, of course, no issue. They have some time. They can get prepared for it. But at the same time, they are having a mock exam. That's a different story, right? So at least you should have started, Sanjana. Priyanka, is she there in the class? Sheba, did you try? Malavika, did you try? Let's get started forecasting. Then only I can, because risk and uncertainty most probably will be continuing tomorrow as well. Tomorrow whole day, today right after the break or before the break, if you start, it will continue until what? Tomorrow. Because that's a bit of a what heavily tested part where in the exam. I thought of doing more past papers questions where under risk and uncertainty, right? Because that topic also a bit of a risk for us. I'm going to do a slightly different strategy to sort out this forecasting. Because you know why? If I'm going to explain the whole part of the forecasting, it will take time. So I'm going to right. Time series analysis, or also you can call forecasting. Forecasting. I just want to bring you a small example to start this chapter, right? You remember we have been discussing about budget. Am I correct? Budget is a predetermined estimation. You will estimate the cost or yeah, that's great, Sanjana. Malavika, you also going for the exam this time, I hope. So Sanjana, Priyanka and all, you should start off working of answering for the questions. So you can upload it. I can check your answers. Then if there are anything that needs to be improved, I can tell you where in the writing part. Because we'll have to balance both. That's why I'm telling you to do it. That one, right? No problem. You do your level best. Because it's not a real exam, no. I'm not expecting you to give a what the complete answer. What is given where in the scheme. I will explain that part. That is my duty, right? If anything that needs to be rectified, because you think that you can write, you think you are soft, you can write, but when it comes to the exam, when you start to write, it won't come out. Nothing will come out. You will be again in the same point because you will not have a time to think. Also, time is a what limiting factor for us, constraint, right? We'll have to get the best usage of what using the what time. So then if you have a what do you call, how to start, how to conclude, right? A bit of a, experience. Once again, learning curve, experience. So it will be perfect. If you keep on doing some work again, you will be master with that work. That is all about what learning curve. So the same technique that I can use for what you exam. You should have a learning curve, right? And you should have to finish it off within the limited time. Right? Okay. Come back to the point. Time series analysis. Do you remember? We have discussed about there are mainly three types of a budget: functional budget, cash budget, and flex budget. In our syllabus content, we discussed only the flex budget, numbers based one. Correct? Flex budget. Then I talked about there is a factor called principal budget factor or budget limiting factor. The point at which you would start the budget preparations process, where you are starting your budget. Generally, it is identified as what? Sales units. Am I correct? Because that is the starting part of what your functional budget. What is exactly meant by functional budget? The budget which you are going to set for the day-to-day operations of a firm. Day-to-day operations mean operational activities. Operational activities mean repetitive activities. Functional activities. What are the company's functional activities? Sales, productions, right? Raw material purchase, administration, marketing. These are what? Daily activities. If you prepare a budget for these daily activities, which is known as what? Functional budget. But this functional budget should begin from what? Sales budget of the firm. It should always start from the what? Sales budget of the firm, which is the what? Principal budget factor. My questions, I raised the same question when I was explaining the principal budget factor. My question, how to identify the sales units? So I brought the example for our discussions. You remember Arivipro, they are going to prepare a budget for the next semester, right? Next semester. Then I asked the question from you all, what will be the number of students? That is what budget says. As long as if you are budgeting for the number of students, from that they would be able to prepare all the other rest of the budgets. The question that I had, how to identify what will be the sales units? What will be the sales unit? That was my question. Can you say this time, let's say you got about what 100 students. So next time somehow we'll have to make it more than 100. Is it possible? Can you say as a company we should go forward? Some of the answer that I got from the class in the last time, right? So we should go forward. Therefore, we'll have to budget our numbers. It should be what? Obviously more than 100. It's not a way of preparing the budget. Whenever you do a budget, there are some factors to be considered. Whenever you do a forecasting, that budget, principal budget factor should be based on what? Some factors. Mainly there are 4 factors. One is long-term trend. T, long-term trend. Second one is seasonal factor. Sorry. Seasonal factor. S. Third, cyclical factor. C. Last one, random factor or residual factor. One is what? Long-term trend. We call it as what? T, right? Seasonal factor S. Third one is a cyclical variation. Fourth one is what? Random factor. By considering these four factors, if you do a forecasting, right? That is the what? Real amount of, not real amount, forecasted proper value of what? Sales. That's the way of finding a sales for the future period. By considering what? These four factors. You remember, we talked about regression equations. Do you remember that? Y equal A plus B X. Why are we using the regression equation? Just to do the future forecasting. Am I correct? Regression equations, because I'm just explaining in detail, you don't go for this depth, right? You don't need to go for this depth. Why I'm explaining in detail? Just to understand the whole concept properly. What are the connection between what? Couple of topics. That's the reason I'm just explaining the whole part of what your syllabus. So I'm just connecting this forecasting part with budget, but it's not part of what your requirement. It's not part of what your syllabus, but just for understanding purposes, I'm telling the purpose of what learning this particular chapter, right? So now, through the regression equations, y equal a plus bx, the main intention is what? To do a future forecast. But that regression equations represent based on the past information. Do you all agree with me? Through the past information only, you are developing a regression equation. You calculated A, you calculated B based on the data what they have given. Do you agree with me? Then you did the what? Future forecast. But the forecasting time series says what? That is not sufficient. Not only considering the past information, but also you'll have to consider the future changes as well. The best example you remember, I have explained about the ice cream company. Ice cream company. Do you remember? There are two seasons, summer and the winter. Let's say first 6 months is a winter. During winter, your sales is 100,000. When you're doing a forecasting for summer, it should be obviously more than what? Winter. Let's say from summer, when you're doing a forecasting for the winter, obviously it would be what? Lower than what? Summer. Am I correct? That is all about what? This forecasting what? Factors. Each and every element properly what? Evaluated. Then we will be doing a future forecasting. That's the reason the management accountants are paid for lump sum of money. All these techniques should have been applied before you what? Do your work where in the company. This is your duty if you are a management accountant. Financial accounting is nothing. Dealing with the consolidation with the help of what your standard IAS 1, IAS 2, IAS 3. Based on the format, you do prepare everything. But the management accounting is not like that. Right? So you have to be very careful because this is what? Tricks and what? Hacks. Am I clear to you? Right? Okay. So now this forecasting, as I have explained earlier, forecasting abbreviation is A. Forecasting. Future forecasting abbreviation is what? A. So this A is consisting four factors T, S, C and R. Do you agree with me? If you are going to add these four factors and if you do a forecasting, which is known as additive model forecasting. Additive model forecasting. If you are going to add these four factors and if you do forecasting, which is known as additive model forecasting. If you multiply these four factors and if you do forecasting, we call it as what? Multiplicative model forecasting. Multiplicative model forecasting. Multiplicative model forecasting. Clear? Now, I will explain one by one each factor. Then I will try to bring you the final formula with regard to the forecasting. First one is a trend, long-term trend. What is exactly meant by long-term trend? It will be either what upward slope, in other words, long-term movements of values recorded over a time period. Long-term movements of values recorded over a time period. It can be even a what upward slope or downward slope or what same constant. Take an example. Let's say you are running an infant milk powder company. Infant milk powder company. Now you're going to do the future predictions, forecasting. When you're doing a future forecasting with regard to what your sales, country's birth rate is very important. Do you agree with me? The birth rate sometimes it may what increase, or it may what reduce, or it may what say. That is all about what long-term movements of values recorded over a time period. But this long-term movements trend, which would be found based on the past information. Past information which will suggest you whether it's a upward slope or the downwards or the same number. Let's say last year your sales was 100, right? Year before also 100. The last 2 years it was suggesting the trend was what same. Next year also it would be what. You got my point. Let's say year before, which was 100, right? Last year it is what, which was what 110. Then how much it has been increased? 10% increase. Therefore, the next year is also it is going to what increase. That's why we call it as what upward slope. If it's going to decline, it will be what negative. So that is all about what long-term trend. Long-term trend is what long-term movements of values recorded over a time period. Long-term movements of values recorded over a time period. Clear? Second one is seasonal factor. Excuse me. What is exactly meant by seasonal factor? It is a short-term fluctuations recorded values over a time period. Short-term fluctuations mean I have clearly told you about what ice cream company. I can also bring you another example with regard to the what umbrella company, right? I can tell you the textile business. If you look at the textile business, during what January, the sales will be higher when compared with what February. Do you agree with me? Why January is what higher? Due to the what season? Due to the what season? So whenever you do a prediction for future, but that will be what in the only what short run, not in the long run. Am I clear to you? Therefore, whenever you do a predictions with regard to your sales, the short-term seasonal factor also has to be considered. That which season that we are doing a prediction. For which season that are we doing a prediction? That is all about what? Seasonal factor. I have brought you the couple of example. Ice cream company, umbrella company, even for your textile business, right? During the season sales, it will be what? Obviously higher than the off season. Are you clear? Third one is what? Cyclical variation. Cyclical variation is a medium term changes. Medium term changes. Excuse me. This is purely related with the economic condition of the country. If the economic condition is good, your sales will be what? Boom. Am I correct? You all agree with me? It will be obviously what? Higher. If the economic condition is poor, automatically your sales will be what? Depressed. Therefore, whenever you do a prediction with regard to what your future sales, you'll have to consider about the what? Economic condition. That is a medium term changes. That is all about what? Cyclical factor. Cyclical factor. Last one, random factor. Random factor means unforeseen event. Or another name is what? Unexpected event. Unforeseen or unexpected event. Fire, flood, tsunami, right? These are the best example with regard to the what? Residual factor or random factor. Right? But your syllabus outline, which has been given very short, they have completed whole part in 3 or 4 pages. If I want to explain the whole part of the forecasting, which will require for me to 6 hours time to complete everything, right? But in your syllabus, it's only 2%. So I don't like to spend the 6 hours time to explain the forecasting. Quickly, I will, uh, go through the important areas of the forecasting and we will jump into the what question, because I'm going to explain to you step by step. Then only you will be able to understand exactly what is meant by forecasting, right? Now, let's have a look. When it comes to the practical scenario, C and R is very difficult to do a predictions. Residual factor, unforeseen event. Can you come and say there will be a flood on next year? Can you say there will be a tsunami on next year? It's very difficult to do a prediction with regard to the what? C and R. Therefore, we are avoiding this for the calculation. We will focus on the additive model. A equals to T plus S additive. Excuse me. If the examiner who is giving you C and R, then you can work. You got my point. As long as if they are giving you C and R, you can work. No problem. But based on the past information, C and R cannot be what? Ascertained. Because you tell me how to identify there will be a, because there was a flood. Can you say there will be a flood? It's very difficult. That's why CNR is what difficult to calculate. Practical circumstances. Therefore, we are going to use the only but A additive model T plus S, multiplicative model A equals to T times what? S. Right. Now, quickly, I'm going to explain to you how to find out the trend, how to find out the seasonal factor and all, step by step. We'll make it very fast, right? We don't have a time. Let's say now we are in 2025, right? 2020, sorry, 23, quarter one. No, we'll start from 20, yeah, 2023, quarter two, quarter three, quarter four. We're doing the prediction based on the quarterly basis. Based on the what? Quarterly basis. And 2024, quarter one, quarter two, quarter three, quarter four. This information has been provided. This is what? Actual sales. Sales A. Right? You can say actual sales or forecasted values. No problem. You can take it anyway. Let's say 80, 84, 82, 86, right? 90, 92, 96, 100. These are the forecasting values or actual values. Actual values. Now, do you remember? I was asking the question from you all, how to do a predictions for next 4 quarters in 25. Quarter one, quarter two, quarter three, quarter four. What is our sales value? This is our task. How are we going to do the what? Future forecasting. In order to do the future forecasting, as I have clearly explained to you, first you'll have to consider the past information and you'll have to consider the what? Future changes. Through the past information only, first we are going to find out what was our past trend, what was our past seasonal factor, right? Based on the past, we will be assuming the future also, which would be continuing with the same numbers. That's the way we will be doing a forecast. Now, first I'm going to explain to you how to identify the trend. Trend, T abbreviation. Most popular method of finding the trend is moving of averages. Moving of what? Averages. What is meant by moving of average is the average of the running total. How to calculate average? You tell me. How to calculate average? Total divided by number of items. As long as if you are able to find out the average, that is the trick. If you are able to find out the average, that is the trick. So now I am going to explain to you, but you need to go for this extent. Once again, I am telling you, you need to go for this extent. Examiner's question, you will be getting the trend, you will be getting the seasonal factor. Equation would be given, you need to find out the what? Forecasting. Right? Because I am going to explain the whole part. One is the knowledge building perspective. Second, there are some questions where in the past papers, you should have a broader knowledge to answer for the questions. You will get to know whether I'm correct or wrong when we are starting to do the what? Questions. When you are starting to do the questions, right? So once again, I'll go back to the trend. How to calculate trend? Moving up average. Moving up average is the average of the what? Running total. Let's say, question says, the company has a policy of calculating trend, 4 quarters moving total. How? 4 quarters moving total. So, first of all, we'll have to find out what is the 4 quarters total. Then if you calculate the average, which is the what? Trend. Agree with me? Just have a look. This is the first 4 quarters. What is the total? First 4 quarters total. Let me know the total. $332. Excuse me, ladies and gentlemen. 332. That 4 quarters moving total. So we got the 4 quarters. The average we mid. Am I correct? So in between Q2 to Q3. Agree with me? In between Q2 to Q3. How much you say? 332. Next 4 quarters would, if it is a 3 years or 3 quarters moving total, it's very easy. Why? Midpoint is exactly what? 1, 2, 3 na second. If it is a 5 also, it's easy. But if it is an odd number, it's very easy. If it is an even number, it will be a problem to calculate the what? Trend. Now I'm going to explain to how are we going to find out that one. So these 4 quarters is what? 332. Now the next 4 quarters would be, listen very carefully, you'll have to skip the first quarter, then you should start from here to here. Then it's very easy, 10 should have been added, 342. Now here we are eliminating 80 and adding what? 90. Therefore the midpoint would be this, 342. Correct? Is that understandable? Is that understandable? So next part would be, let us skip what? Q2, Q3 to what? Here. This would be the midpoint. So we are skipping 84 and adding 8. Then 350. Just double check. 350. Now we are going to find out the 4 quarters moving total. Just have a look. Four quarters moving total would be 332 plus 342 divided by 2. How much? No. 332 plus 342 divided by 2. Won't be. 674. Very good. 337. 330. These two values are falling. Just have a look very carefully. These two values are falling in between Q2 to Q3. Therefore, 337 for this one. Agree with me? 337 for this one. Note 4 quarters moving for Q1. No value for what? Q2. We have started only from what? 337, which is what? Quarter number 3. Now we can find out the quarter number 4. How? 342 plus what? 350 divided by 2, which is how much? $340. Yeah, in between that 46. Yes. 346 comes for this one. Do you all agree with me? This is the way continuously you can calculate, I believe, until 2024, until second quarter. Clear? But still I didn't find out the trend. I have calculated only what? 4 quarters moving total. But we won't be facing this issue if we are going to deal with the what? Odd numbers. Straight away we can get the what? Midpoint. There's no what? Double work. But here we did the what? Double work since we are dealing with the what? Even numbers. Right? Now we can find out the what? Trend. Sorry. Now we can find out the what? Trend. Trend means what? T. Average. Trend means what? Average. Nothing for first quarter. Nothing for what? First quarter. Nothing for what? Second quarter. But third quarter only we are going to start the trend. 337 divided by 4. But 337 is the, total of 4 quarters. No? Am I correct? How much? 84.25. Very good. 84.25. That is the way of finding the trend. Right? How to calculate for quarter number 4? Quarter number 4. Right, okay. Very good. Correct. Likewise, you can calculate the trend for what? Until 24 second quarter. Is that understandable? The way of finding the trend? Trend is what? Very, very simple. Total divided by what? Numbers, which is similar to the what? Average. That is what I did. I got the total. But we did the double work since we are dealing with the what? Even number. I just wrote the what? More complicated one. Once again. If it is a odd number, it's very easy. How? I just explained the odd number here. Let's say this is 10, this is 14, this is 20, this is 16, right? 3 quarters moving or 3 years moving average. You'll get the total of 3 starting the midpoint here. So then let's say how much? 34, 44. Correct? Then you can find out the trend. How to calculate the trend? 44 divided by 3. Am I correct? That would give you 14 point something. Nothing for the first quarter. First year. Starting from the what? Second year onwards. So second quarter. Next 3 years would be from here to here. This would be the midpoint. You'll be finding the trend. That's very easy. If they would have given you what? Even now. Starting the midpoint is very easy. But here, since we are dealing with the what? Even number only, we did the double work and we found the trend. Is that understandable? Are you okay with the trend? Next part is very easy. Seasonal factor. Assuming there is no cyclical factor and random factor. A equals to T plus S. Additive model. Do you agree with me? Additive model. Additive model. A equals to T plus S. Therefore, S equals to what? A minus T. Do you agree with me? A minus T under additive model. Correct? So nothing for the first quarter and second quarter. Starting from what? Third quarter. How? You know A. How much? 82. You know what? T. A minus T. 82 minus 84.25. Which is how much? Yes, correct. Minus 2.25. Now you can calculate for quarter number 4. 86 minus 86.5. Minus 0.5. This is the way of calculating seasonal factor. Is that understandable? So when it comes to online student, are you all okay what I have explained as of now? Are you all okay? Malavika? Arokya? Rachana? Navya? I need answer from everyone. Emily? why we have divided, we have added 2 and we divided by, sorry, we have added two factors or two values and we divided by what, 2, just to get the total of what, 4. Am I correct? Now, how to calculate a multiplicative model? A multiplicative model, multiplicative, right? You know A equals to T times S, correct? S equals to A divided by what? T. Agree with me? A divided by T. Now you know A, 82 divided by what? 84.25. How much? 0.9732. Yeah, 3. Right? 3 decimal places. Next one is what? 86 divided by 86.5. 0.994. Right, okay. This is the way of calculating seasonal factor under multiplicative model. Is that understandable? Is that clear? Right. Likewise, you will be calculating seasonal factor, trend, everything for each quarter separately. Listen very carefully. Now only I'm moving to the very important point. Different value, it will be reported. Am I correct? Now I'm asking only small point with regard to the trend. Look at the trend. 84.25 has become how much? 86.5. Therefore, it will tend to increase. It's what? Increasing. Do you agree with me? Our future also, our assumption, it will what? Increase. The different quarter, it will increase the what? Different amount. Different quarter, it will increase. But say for an example, I'm telling you. The next one is, let's say, 87.5. Correct? Next one is example, not the actual values. I'm just putting the example. Next quarter, let's say 88. Next quarter, let's say 89. Likewise, different amount is increasing for different quarter. Therefore, when you are doing a future forecasting, we will be assuming in future also trend is going to what? Increase. Do you all agree with me? Based on the what? Past information. Now the problem would arise. How much is going to increase? Because you know why? Different quarter, it's reported with the what? Different amount. Different quarter, it was reported. Look at here. First one is what? Almost what? 1.75. The second one is what? 1. Third one is what? 0.5. Next one is what? 1. Different amount is increasing. Now what we have to do is, we'll have to find out averagely how much is increasing. That's we call it as what? Average trend. So what you have to do is, you have to get the difference from each quarter. Correct? Then you have to add everything, divided by number of items. You will be finding the what? Average. But the easiest way of getting the average trend, take the highest value minus lowest value divided by what? Number of period. The final answer, let's say 0.75. Average trend is how much? 0.75. Which means averagely each quarter trend is increasing by how much? 0.75. Is that understandable? Is that understandable? So what we are going to identify, because we can't get the exact figure, because we are doing a forecasting. We are doing a budget. Budget, what we are going to set based on the past information and the future changes. So the past information is suggesting each quarter trend is averagely increasing by how much? 0.75. Now there's a problem with the seasonal factor. Based on the past seasonal factor, we will be doing a future. Let's talk about the first additive model. Listen very carefully. Additive model, seasonal factor. Right? Now we are going to do the future forecasting for 2025, all 4 quarters. Based on the which information? Past information. Based on the which information? Past information. Let's say quarter 1, quarter 2, quarter 3, quarter 4. Right? 2023 and 2024 information is there. After doing all the calculation, we can get the information. Let's say that information say there is no seasonal factor at quarter 1, no quarter 3, quarter 2, quarter 3, let's say 0. You calculated how much? Minus 2.25. Minus 2.25. Right? Quarter 4, you calculated minus 5. Minus 5. Right? Quarter 1 for 2024, let's say minus, plus 7. Right? Example, I'm telling you. Quarter 3, let's say plus 3.5. Right? Let's say Q3, say example, Q3, let's say 1.75 minus, right? This is 2.5 minus. So likewise, we got the number. I assume the Q1 on Q3 also, right? It's easy for you to understand. Let's say this is plus 3, right? Let's say this is what 1.5. Likewise, we got the seasonal factor. Now we are going to do the, listen very carefully, we are going to do the future forecasting based on the past information. The future forecasting in 2025 for the first quarter. First quarter, when you are doing a forecasting, you'll have to check the what past information. Look at the past information. Q1 23 says what? Plus 3. Right? Same quarter, quarter number 1, 24 says how much? Plus 7. Now the problem would arise. Which seasonal factor will be taken to do the future forecasting? Different quarter, it's reported with the what? Different seasonal factor. To solve this problem, what we are going to do is once again we'll be finding the what? Average seasonal factor. Average seasonal factor. How to find out average seasonal factor? Get the total. Here what? Plus 10. Am I correct? Here what? Plus 5. Here minus 3, 4. Correct? Here minus 3. Right? Now let's get the what? Average seasonal factor. Average seasonal factor. Plus 5 plus 2.5 minus 2 minus 1.5. Is that understandable? Is that understandable? Now, whenever you do a future forecasting based on the additive model, your seasonal factor for Q1 is how much? Plus 5. Seasonal factor for Q2 is how much? Plus 2. But there's a small problem. There's a small problem. Sometimes we may be dealing with the what? Decimal numbers. When we are dealing with the decimal numbers, these numbers are what? Not accurate. These numbers are what? Not accurate. Therefore, based on the additive model, if there are 4 quarters, total should be what? 4. Total should be how much? 4. Then how much here? Plus 7. How much here? Plus 5, plus 2.5, then plus 7.5. Am I correct? Minus 2, 3.5. The answer is what? Plus 4. Agree with me? Answer is what? Plus 4. If there are 4 quarters, the total you should have got what? 0. You should have got what? 0. Some other problem only you got what? Plus 4. That should have been adjusted. How to adjust? You have to remove what is minus 4. If you are removing from the total, that should be shared between what? All 4 quarters. This we call it as what? Adjustment. 1, 1, 1, 1. All are minus. Because the total is also minus now. 4. Then only you can get it what? 0. So this would be 4 then. Average adjusted seasonal factor. This would be 1.5. This would be minus 3. This would be minus 2.5. Now, whenever you do a future forecasting, average adjusted seasonal factor for Q1 additive model, how much? 4. Understand what I said? Second quarter, based on the past information, average adjusted seasonal factor is how much? 1.5. Q3 is what? Minus 3. Then A equal T plus what? S. Here T A equal what? T minus, sorry, T times what? S under multiplicative model. Are you clear additive model? Now when it comes to multiplicative model, same way. Q1, Q2, but here only there's a small issue, Q4. Finally, you will be calculating what? Average seasonal factor. Average seasonal factor, right? Let's say this is what 0.9, right? This is 1.2, right? This is, let's say, 0.8. This is 1.4. Average seasonal factor. Now, what is the average total here? Average total 0.9 plus 1.2. Because you know how to calculate average. First, each seasonal factor should have been placed. Then you have to divide by the number of quarters. Then you can calculate the what? Average seasonal factor. How much? 4.3. Right. Make sure here you have to always bring to the what? Nearest whole number. Nearest whole number. In other words, if there are 4 quarters moving total should be what? 4. Total should be what? 4. Now this 0.3 to be subtracted. Am I correct? Then only you will be getting what? 4. Now this 0.3 should have been allocated for adjustment. All 4 quarters. How much? 0.3 divided by 4. 0.75. Correct? So we'll make it a little, easiest number for understanding purposes. Otherwise, it will be a problem for you to understand. Give me a second. Right. What is the total now? Get me the total quickly. 0.7, 1.2, 0. How much the total? Excuse me. Additive model adjustment should be made to what? 0. Adjustment should be made to what? 0 for additive model. Under multiplicative model, adjustment to the nearest whole number. In other words, if there are 4 quarters moving total should be what? 4. Excuse me, don't get me wrong. This is basically 4 to 6 hours part. I'm just bringing to 1 hour maximum, 1 or 1.5 hours. But all the part which I have explained quickly to bring it to the what our requirement now. Still we didn't come to what how it will be tested by in the exam. So after all this explanation only, I'm going to explain to you how it will be tested in the exam. Examiner's questions are very easy. You don't have to worry about it. I'll give you the hint how to handle the questions by in the exam. But why I'm explaining this much? Just to get the what broader picture. Right? Just give me some time. Then you tell me whether you understood or not. Right? Okay. What is the total? 3.8. 3.6 now. Good. And now I'll do small changes. You got 3.8, no? Then 0.6. 0.7. Right. Now you are getting how much? Just take 1.8, 3.6. 3.6. Okay, 3.6. Now it's easy. So if there are 4 quarters, it can be sometime added, it can be what? Deducted. It depends on the questions, right? Adjustment. To make it what 4, you'll have to add 0.4. Agree with me? That's the nearest whole number. Or you can say what? You'll have to bring it to the what? 4 quarters moving total now 4. 3 days moving total now 3. 5 days moving total. Total should be what? 5. Now this 0.4 should have been shared between what? All 4 quarters. Now it has to be added. then 0.1 to be added, 0.1 to be added, 0.1 to be added, 0.1 to be added. Now 0.7, 1.3, 0.8, 1.2. This we call it as what? Average adjusted seasonal factor. When you're doing a multiplicative model forecasting, forecasting can be done in two ways. Either what? Additive model, multiplicative model. Listen very carefully. Now only the your examiner's part. Examiner, they won't give you what the seasonal factor. They won't give you what the seasonal factor. Listen very carefully. Sometimes they say what? First quarter seasonal factor is 70%. Then what is the seasonal factor? 70% now. 0.7 in terms of percentage is how much? 0.7 in terms of percentage is how much? 70%. Sometimes here they say index value is 130%. What is the seasonal factor? 1.3. Here they say what? 80%. Here they say what? 120%. This is one way they will give you the what do you call percentages, which we call it as what? Index value. If we call it as what? Index value. That's another way. That is the bit of a what confusing one. If they would have given you straight away the what index without the what percentage, we can get the seasonal factor. Do you agree with me? Without the percentage, we can get the without 70% without the percentage is what? 0.7. 1.3, sorry, 130% without the percentage is what? 1.3. Now, listen, how they will make you to confuse. Here, 0.7. If there are 4 quarters, each quarter average should be how much? 1. Average should be how much? 1. To get 1, how much is the shortfall? How much is the shortfall? 0.3. 0.3 is a shortfall. No, shortfall means in the form of negative or in the form of positive? Shortfall. No, you will have to add 0.3 to get what? 1. Listen very carefully. This is the part which will be tested in the exam. That's what I'm telling you. To get 1, 0.3 to be added. Now I'm asking for you whether it's a shortfall or the surplus. Shortfall means in the form of negative or positive? Negative. Therefore, 0.3 is what? Negative here. Shortfall. In terms of percentage, minus 30% is what? Negative. You will understand further when I explain the whole part. Here Q2, 1.3 is the answer. Do you have to get 1, surplus or shortfall? How many percent surplus? Plus 30%. Here what? Shortfall. How much? Yeah, 0.2 in terms of percentage, minus 20%. Here, plus 20%. They say seasonal variations are these, what do you call? These values. Then a lot of students, what they do? Minus 30% now. They say what? 1.3 minus. Or they say what? Minus 3%. You are wrong. This is the seasonal variation that has been provided. If it is a minus 30%, to get the seasonal factor, don't forget 1 minus what? 100% minus 30%, which is how much? What is the original seasonal factor? 0.7. Plus 30%. Now, your seasonal factor should have been added with 1. Each and every negative percentage should have been subtracted from 1. Every plus 1 should have been what? Adjusted with what? It means what? Added with what? 1. Look at plus 20%. If you add with 1, what is the seasonal factor? 1.2. Minus 5%. What is the seasonal factor? You tell me. Minus 5%. What is the seasonal factor? Let us deduct from 1. If you deduct from 1, that would give you what? 0. Minus 5%, not 50%. 0.95. Minus 15%. What is the seasonal factor? Very good. 0.85. Minus 30%. What is the seasonal factor? 0.7. Minus 13%. What is the seasonal factor? Minus 13%. 0.87. Plus 12%. What is the seasonal factor? Plus 12%. Plus 9, it should have been added with what? 1. 1.1. Plus 15%. What is the seasonal factor? 1.1. Plus 17%. What is the seasonal factor? Minus 16%. What is the seasonal factor? That's the way of finding the seasonal factor. If they would have given you what? Minus and plus. You tell me, if I straight away explain that part, can you all understand without explaining the whole part of what this seasonal factor? Can I come and explain to you only that percentages? But if they would have given you only the index value, how 110%, then the seasonal factor is 1.1. Anything which is given negative and positive, then working backwards and you have to find out the seasonal factor. Negative na deduct from 1, positive na add from what? 1 and get the seasonal factor. If they would have given the index value, that is the seasonal factor. Please make a note on that on your own English word, please. Everyone, please make a note on that on your own English word. If the percentages being given positive and negative, to get the seasonal factor, adjust with 1. Adjust with 1. If the index is given, straight away take that as a seasonal factor. Very challenging task for me. If the index, you can take down any own English word, anything that as long as you understood what I have explained. That's more than enough. Online student, are you all okay? Online, are you all okay? Are you all okay? Sanjana? Malavika? I don't know what happened to Priyanka. Priyanka is absent for last couple of classes, I believe. Any idea? No idea. Then she is not your friend. As long as she is your friend, you should know. Am I correct? And what is her name? There's a girl who used to come for the class. She was very good in the class also. Sachini. She is not there. But I'm wondering because I just met one guy yesterday. Then I asked, are you coming for the class? Then he said, no, sir, I am having some work. But then I asked, are you going for the exam this time? Yes, I'm going for the exam. I don't think, to be honest, I'm telling you, according to my experience, I'm telling you for ACCA PM, just preferring the recording only at once, if you're not good with the subject, it will be a problem for you to understand. Can I explain all these part in the Excel? It will take time to explain everything. That's why I'm using the whiteboard. It's easy for you to even understand. Right? But you can do it via in Excel. That's not a problem. You can take time now because you're going to do the exam via in the Excel. Right? I forgot to tell you that part. The probability is very less of passing the exam. Because some people who thinks this can be done just doing a last minute preparations of just focusing the 2-3 weeks only for the exam. I don't think. You know the syllabus is very vast. To be honest, I'm telling you, I'm lecturing for SEMA, Chartered Institute of Management Accounting. Most of the, definition which is there with these people I have taken from SEMA. I'm doing CMA. I'm doing a couple of, university, degree program. But only the PM syllabus is for management accounting is very vast. Also, the paper also got very hard. Paper is very hard. But the passing the exam depends on how much the effort that you are putting where your side. I can do 1 or 2 past papers question, but you should complete all the past papers question before you go for an exam, right? But here we are spending almost 1.5 hours time just to get the 2 or 4 marks for index. This is only 2 or 4 marks maximum, right? But the risk and uncertainty, definitely it will be 10 marks or 15 marks, which would give you. You got my point. But my bad luck to explain this part, I'll let it start from the scratch. That's why I have started from the scratch with regard to the forecasting, right? So make sure these percentages, any index is given, that is the what seasonal factor. Anything which is given in the form of what positive or negative, from one, adjust and get the seasonal factor. If it is a plus, add with 1. If it is what negative, deduct from 1. Still, I didn't come to the what last part of the forecasting. What is the last part of the forecasting? How are we going to do the future forecasting? If you go back to my question, the requirement, right? Let's say we got the trend for until Q2. This is 97 example, right? We got the trend. Now, listen very carefully. I'm going to do the forecasting for 2025 first quarter. Listen very carefully. This also will be tested. 2025 quarter number 1. This quarter number 1 forecasting. Forecasting means A. Agree with me? A equals to one option we have T plus S. Another option we have T times what? S. Now S is not a problem. We have already calculated. We have S. Additive model S is there for each quarter separately. Multiplicative model S is there for each quarter. Now we need to find out 2025 trend first. First quarter trend. We have here calculated trend until 2024 what? Second quarter. Do you agree with me? 2025 until what? Second quarter. That is what? 90. Let's we call it as what? A. 2025 trend is how much? 90, which is what? A. Now every quarter we have calculated trend is going to increase by how much? 0.75. Agree with me? Every quarter it is going to increase by how much? 0.75. That is what? B plus B 0.75. But we are going to calculate from 2024 to 2025 first quarter. Then first the 2024 we have calculated until second quarter. The next quarter would be what? 2024 third quarter. The trend would be 90.75. Do you agree with me? Trend would be 90.75. How to calculate 2024 fourth quarter trend? 90 plus 0.75 times 2. Agree with me? Agree with me? How to calculate 2025 first quarter trend? 90 plus 0.75 times what? 3. So 90 is representing 2024 second quarter. So now from 2024 second quarter, we are jumping to do a forecasting. To do a forecasting, 2025 what? First quarter. So every quarter, we found the trend is increasing by what? 0.75 average. In order to calculate 2025 first quarter trend, 90 plus 0.75, into what? 3. That is what? Dx. This is the way of developing a regression equation through the what? Forecasting. Now we will be finding the trend. How much? 90 plus 0.75 times 3 is how much? 2.25. Therefore 92.5. 92.25. But 92.5. 92.25. That is the trend. That is the trend. We found the trend for 2025 what? First quarter. You tell me how to calculate the trend for 2025 second quarter. We have two options. One option 92.25 plus 0.75, or if you are working from the equation 90 plus 0.75 times what? 4. Sometimes you may ask the question why that is 4, because we started from what? 2024 what? Second quarter. That 90 is representing for 2024 second quarter. We are jumping to what? 2025 what? Second quarter. Then how to calculate 2025 third quarter? 90 plus 0.75 times what? 5. That is what we call number of period x. Now we can find out what? It's very easy. A equals to T plus S. T, you know what? 92.25. Seasonal factor, right? Go back. Additive model. We have calculated. How much? 4. Additive model forecasting is how much? Seasonal factor? 4. Now what we can do is, this is what? 4. If it is minus now, minus. Multiplicative model, A equal T times S. T we found what? 92.25. Seasonal factor. And a multiplicative model, we calculated how much? 0.7. 0.7. That here 0.7. Same way we'll be doing the forecasting for Q2, Q. This is the way they will prepare a budget. This is the point they will start the budget. This is the whole part of what? Forecast. Are you clear? Shall we go back to the questions now? What we have copied yesterday, you have shared already. We skip couple of questions. We are supposed to work from 166 and get me the answer. We missed out only 2 questions. Am I correct? 166 and 170. Am I correct? Can you get me the answer only for those two? Just to answer those 2 questions, I have explained all this part. Questions are very easy. Are you all done? What's the answer of the first one? Very easiest question. Both are very straightforward questions. Now you know how they have developed equations. Am I correct? You know this equation, where it has come. Sanjana has got us 150. Malavika, there's a question from Malavika. So, what is the denominator for average trend? That is based on the number of periods, Malavika, because I have done the complete questions, no. But you don't go for that extent. I can tell you highest value minus lowest value. Then you'll be finding the number of period. That is the denominator for average trend. Number of periods. Or you can find out the average trend one by one. You can divide by number of periods. Either way, the answer can be obtained. Sanjana, you have got 150. For what? There's no answer for 150, no, Sanjana. For question number 166. They have given the index value. Look at the questions. Index value means what? You don't need to do any adjustment. Without the percentage, you can take as a seasonal factor. Without the percentage, you can take as a seasonal factor. Correct? Look at the question. Anybody? Malavika has got one answer. We'll check that one, Malavika. I don't know. Sanjana says what 150. For which part of the question? 150. Question number 170. We'll check that one. No problem. 166. First question. Is anybody who have got the answers here? Why? You can't take more than 5 minutes for both questions. It's very easiest questions though. Trend is given 25,000 plus 6,500 x. This is the trend equations. What is this trend equation? If I want to tell you, these equations they're talking about 90 plus 0.75. They have given only these two elements. Then x they say what? Number of periods. They say x is what? Number of periods. Now the x they have given, look at where the y is total sales unit, x is the time period for reference number, Z Limited has derived the following set of seasonal variation for all 4 quarters they have given to you. Assuming that the first quarter of year 1 is the information being provided. This equation they have given, but first year, first quarter. First year, first quarter. The time period for the reference number is 1. What would be the forecast sales unit for the third quarter of what? Year 7. Third quarter of year 7. Then how many quarters? Third quarter of year 7 means 20. Third quarter, for that also I can explain to you. That is a very basic thing. You should know third quarter of year 7 now. How many quarters? Completed 6 years. Then 24 quarters. 24 quarters. And another 3 more quarters. Third quarter of year 7 means 27. Do you all agree with me? Online student, third quarter of year 7 means 27 quarters. Therefore, 25,000 plus what? 6,500 times what? 27. Because the x represent for what number of quarters? X represent. It is not compulsory for each and every question should be what number of quarter. Sometime it will be what number of month. Right? Sometime what number of years. If they would have given you x represent for number of years, 70 years, then how many years then? What is the year 7? Forecaster says. The number of period is how many years? 7 years. Number of years is what? 7 years. But here the information being provided, but so you tell me same question. If it is number of months, how many months? No. Same question. If it is the number of months now, how many months? 6 years, 6 times 12, how much? 72. Plus, not only that, seventh year, how many, which quarter? Third quarter. So third quarter now, there are what, 6, yeah, September, 9 months. Then 72 plus 9, 81. You got my point. But here it's given what number of quarters. Therefore, we took it as what number of quarters, which is 27. Therefore, what is the trend? 2 lakhs and 500. Malavika, that is your answer as only for trend. Requirement is what? Forecast says for multiplicative model. Then A equals to T times S. This is what? 70th quarter number 3. Correct? So T you found 200,500. Correct? Seasonal factor for third quarter. What is the seasonal factor? 150%. 150% mean what is the seasonal factor? 150 percentage mean what is the seasonal factor? For that you don't need to use the calculator. 1 point, yeah, 1.5. 1.5 is a seasonal factor. For that you don't need to use a calculator. 300,000, 750. Correct. Now with that knowledge, at least can you try the next question, please? At least can you try the next question, please? With that same knowledge, I'll give you a couple of minutes time to get the answers. What's the answer? Sorry? 150. What about others? Right, okay. Let's try. Monthly sales for the product are follow a linear trend. Y equals to 9.72 plus 5.816x. Correct? The number of units sold, X is the number of month. They have given what? Number of month. So 9.72 plus 5.816. What is the number of month? The forecast number of units of the product are to be sold in month 23. Straight away given. Month what? 23. If they would have given you after 4 years, then what is the number of months? You can't put 4. If they would have given you after 4 years, it should be what? 48. If they would have given you 2 years, it should be what? 24. Am I correct? But here straight away they have given what? 23rd month. Therefore, times what? 23. Then the trend is how much? 128.998. 143.018. Right? Now the additive model A equals to what? T plus S. T plus S. 143.018. Seasonal factor is how much? Plus 6.5. That would give you 149 something. Closest answer is 150. Sanjana, you are correct. Malavika, you are also correct. 448. Then 104. Yeah, closest one is 150. So answer D. Clear? That's all. There's a one only in a whole past paper. There's only one question being tested as for 20 marks with the budgeting. If you want, I can share that question, or you can do it later. You can do it later. It's in the past paper. You can try at home. Shall I share that questions? Answers also. suggested answer also. You just have a try at home, right? That's better. Right? You can check the questions and answer at home. I've given that question as a reference, but very rarely I would say that would be tested what section C. But if somebody wants to test you, right? Don't know. See how they have given the answer for theory based questions. That's the way you should write. Risk and uncertainty. Like standard costing or budgeting, no paper will be designed without what? Risk and uncertainty. It will be there, it can be what sections B or section C. Definitely there will be a question. Either section B or section C. Try to learn everything under risk and uncertainty. We will be discussing some complicated questions as well under risk and uncertainty. Until you put the effort for this particular area, you won't be able to understand. As I said earlier, it's a two-ways approach. Two-ways approach, right? Okay. What is meant by risk? What is meant by risk? Uncertainty. We use this terminology interchangeably when the practical circumstances. Do you agree with me? But there are significant differences between what? Risk and uncertainty. Risk is what we? Very good, very good, very good. Then we can't. Very good, very good. Each business transaction that we make within the company, or each business decision that we take within the company, there's a hidden element of what? Risk. There's a hidden element of what? Risk. Each and every transaction, each and every situation that you face within the company, you are dealing with what? Risk and uncertainty. Not as a name of what? Risk or uncertainty. As a management accountant, it should have been evaluated properly. Then we need to give the report to the what? Management for them to make what? Right decision at the right time. Right? So what is exactly meant by risk? As you said, it is what? Statistically measured. It can be calculated with a reasonable probability. That is what is known as risk. Whereas if you look at uncertainty, that is what? Pitch black. Don't know what is happening behind the screen. Little vast, broad. So as you said, that cannot be measured in terms of what? Probability. Say for an example, you are throwing a die. Die. Die is a singular, right? dice is plural, right? Throwing a die. When you are throwing a die, you know you will be getting 1 out of 6. That is what is known as risk. Do you agree with me? Uncertainty is not like that. You don't know anything. I can give you the number of example to understand the what risk and uncertainty. Risk, as you said, it is calculated risk, right? It can be measured with a reasonable but probability. That is what is known as risk. Whereas uncertainty, it cannot be measured, right? Outcome will be there, but don't know the what probability. Probabilities are what unknown. That is all about what uncertainty. Best example. Let's say the oil digging company says, right, that there is a 60% chance of finding oil. That is what risk. Since it is given with the what reasonable probability, in other words, there's a 40% chance of what not finding oil. Correct? What is meant by uncertainty? Uncertainty. Oil digging company says there is a chance of what finding oil. That is what is known as uncertain. But don't know the probability. Don't know the probability. Another best example with regard to what your exam. You're going to go for the exam. There is a 70% chance of what passing exam. 30% chance of what failing exam. That is what is known as risk. What is meant by uncertainty? As I have told you earlier, don't know what is happening behind the screen, right? Little broader. So in case if you fail the exam, what is waiting but your home? It's uncertainty. Don't know whether they are going to what chase you out. Am I correct? You will run away from home. Don't know. That is what uncertainty, right? So another example, let's say you are doing a business where in the local market, you want to expand your operation, you want to go for an international market. There is a 70% chance of success. Then the 30% chance is what? Fail. That is what? Risk. What is meant by uncertainty? In case if the business is going to fail, don't know what is going to happen for what? Your existing business where in the local market. That is what uncertainty. Are you clear? So very simple. No need to go for a in detailed explanation with regard to the risk and uncertainty. As you said, right? Very short and sweet. Anything which can be measured with the probability is what? Risk. Anything which is not measured with the probability, which is what? Uncertainty. Clear? To evaluate this technique, risk and uncertainty, there are n number of techniques. There are n number of techniques. One we say expected value, EV. Another one we say what? Decision tree. Right? Another one we say what? Payoff table. Payoff table. Under payoff table, maxi mini max regret. These are the techniques that are we going to evaluate the what? Risk and uncertainty. Then again we are having, just have a look, standard deviation, coefficients of variation. These two are not part of our syllabus. In addition to that, we have what? Sensitivity analysis, right? Then we have simulations. These are the techniques which is available to evaluate, to discuss what? Risk and uncertainty. Expected value, first one, EV. Second one is what? Decision tree. Another name is what? Probability tree. Another name is what? Decision diagrams. All are correct. Third one is payoff table. Under payoff table, there are three what techniques, sub technique: maxi max, maxi mini, mini max, regret, mini max, regret table. With that only we will be calculating VOPI, value of perfect informations. Value of perfect information, VOPI. This is not part of our syllabus for the time being. Maybe we would have done that part where in the upper level. Sorry, would have done that but in the knowledge level, standard deviation and coefficient of variations. That is also which you are going to evaluate the what risk. But you have learned not as a name of what risk. You just learn what is meant by standard deviation, how to calculate standard deviation, how to calculate coefficients of variation. That is what you have learned. Excuse me. There are some books and some professors, they say all these techniques which you can evaluate risk. Based on my finding, what I have come to the conclusion, to evaluate the risk, we have only two techniques: expected value and the what? Decision tree. All the other techniques, maxi max, maxi mini, mini max, regret, these are the techniques which you can evaluate the uncertainty. That is my finding. My finding, right? Because I have come to conclusion through a one past paper question from the one professional module. There was one question in the past paper. What are the techniques which is available to evaluate only uncertainty, not the risk? If they would have asked the question risk and uncertainty, you would have mentioned all these techniques. Only uncertainty can be evaluated through the what payoff table, which is what maxi max, maxi mini. Third one is what mini max, regret. Have you all done this terminology before? This technique before? Have you all done? Yeah, knowledge then. Okay. Which the maxi max and all? Super. Right. Now, before we get started these techniques, right? So these techniques are available for different types of decision maker. Different types of what? Decision maker or risk pursuer or risk preferences. There are three types of a decision maker. One, we say risk neutral person. Second one, risk seeker, risk taker, optimistics, positive thinkers, all are same. Risk seekers means what? Risk taker, optimistics, positive thinkers, all are correct. Last one, risk averse person. Pessimistics, negative thinkers, negative thinkers, negative thinkers. Right? So now, if you are a management accountant, you will have to report to the what? All three types of a decision maker, or as you don't know under which category your management is falling. So we will have to get ready for what? All three types of a decision maker. If you look at your top management where in your company, you can see he can be a what? Neutral, or he can be a what? Seeker, or he can be a what? A first person. So risk neutral, make sure he will use a technique called expected value and the decision tree. expected value, and this we'll be learning each and every technique one by one. You don't worry about it. I'm just giving the broad explanation with regard to what all part of what risk and uncertainty. If you look at risk seeker, he will use the technique what's maxi-max. He will use the technique for maxi-max. Risk averse person, he will use maxi mini max regret, and he will use standard deviation and coefficients of variation. It is used by only but risk averse person. Here decision criteria which would be based on what these techniques: maxi mini max regret, standard deviation and coefficients of variation for the risk averse person. My plan is to cover at least 20 marks 3 questions and 10 marks 2 questions, 5 to 10 questions under what section A for only for this chapter. Why? It is something like a standard costing, which is what heavily tested part where in the exam. Now, first of all, you should know what is meant by risk neutral person. What is meant by neutral? In between the sec and hours. In between sec and hours. So, what do you mean by neutral? Very good. He is falling in between what sec and hours. Basically, he will trade off between what risk and return. That's the reason he does calculate what expected value. What is meant by expected value? He will focus on the what average. Wherever you are getting the what highest average, you will go with the what that particular options or the project. That is all about what risk neutral, right? Trade between what risk and return. Wherever you are getting what that is the best option of what checking the risk and return is what expected value. We'll be learning what is meant by expected value. Checking with the what expected value. Wherever you are getting the what highest expected value, he will select that particular project. Second person is what risk seekers. He is not worried about what likelihood. What is meant by likelihood? Likelihood means what? Probability. He doesn't worry about the likelihood. Risk. He wants to take risk. He doesn't care about what the probability. His focus is what? Wherever you are getting the what highest amount, that project will be chosen. If A is giving you 100, that will be chosen. Even though if the probability is very less, sometimes there's a 1% chances of making 100,000. 99% chance is making loss of what? 5,000. Then he would say 1% chance no. He's a risk seeker. He wants to take risk. He says what the 1% would be. He doesn't worry about the what? Probability. His eyes will see the amount of what? That 100,000. A na 100,000. B na what? 40,000. 100,000 is better than what? 40 for me. Therefore, I will go with the what? Project A. That is all about what? Risk seeker, taker, optimistic, positive thinker. Clear? Last one. risk averse person. He doesn't want to take risk. He is always looking to the what negative way. From the negative, he takes the what best. From the negative, what is the best? You got my point. That's why we call it as what maximini. From the minimum, he will check the what is the maximum. That is all about what risk averse person. That is what pessimistics. Pessimistics, right? And he doesn't want to take what risk. Negative thinkers, right? So let's discuss this part in detail right after the break. Before that, do you have any questions? Do you have any questions? Online students, do you have any question? Risk uncertainty. Excuse me. If you look at forecasting, if you look at regression equations, if you look at correlation, those are not heavily tested. But there is a chance of getting what 2 to 4 marks question wherever. But the risk and uncertainty, standard costing, budgeting, activity based costing, throughput accounting, right? Short term decision making, linear programming, break even. Out of the whole, the main area is what risk and uncertainty, performance measurement, the next chapter, which we are going to discuss on Friday. Right? Those are what heavily tested part behind the exam. Transfer pricing. You'll have to make sure that part. Without having a thorough knowledge with regard to the important topics, you can't go for the exam. There will be a problem. Right? Any questions before we take the break? Online students. Malavika, are you okay? Any idea what happened to Priyanka? I don't know. Even she was absent last class, yesterday's. Do you have any questions? Excuse me. Anjana, do you have any questions? Yes, problem. Please go through that forecasting question, the structured question, 20 marks one, just as a reference, because that's why I have shared you the question and answer. The answers be given with the what very long paragraph. Right? Try to understand what they are talking, but I hope that I'm there. Where the explanations, what they have given where in the 2 paragraph, it's what based on what my explanation, what I did where in the class. Right? We can have a break. Take a break and come. We'll continue risk and uncertainty with example. Right? Right. Let's get started with a small example. Through that example, I will try to explain to you with regard to the decision criterion for all three types of our decision maker. All three types of our decision makers. Before that, you just quickly take down the small heading expected value. Expected value. EV. Expected value. Mark under that. Expected value can be broadly identified as expected value can be broadly identified as the possible outcome of a given event. The possible outcome of a given event. Of a given event. Full stop and continue. This is highly practical technique. Practical technique which has been developed to obtain the informations for decision making. For decision making. Decision making, right? If you look at expected value, EV equal V times P. V stand for value, P stand for probability. Probability. Don't forget this technique which is used by the risk neutral person. Risk neutral person. No need to take down, try to remember that point, right? Listen very carefully. I'm going to explain the all three types of decision preferences through a small example. Let's say there are two projects, projects A and the project B, right? If you start the project A, 60% chance of making profit, $50,000, right? Then the remaining 40% chance making profit $80,000. Clear? This is the information with regard to the what? Project A. At the same time, if you look at project B, it says 70% chance making profit 90,000. At the same time, 30% chance making loss 50,000. Or we'll make it 40,000, else you may get confused sometimes. $40,000. Are you clear with the example? There are two projects. One is a project A, other one is what? Project B. If you start the project A, 60% chance of making profit how much? 50,000. 40% chance of making profit is how much? 80,000. Or you can start the project B, 70% chance of making what? 90,000 profit, and 30% chance of making loss is how much? 40,000. Clear? If you are going to take a decision based on the expected value criterion, which is applicable for what? Risk neutral. If the projects are mutually exclusive, what is meant by mutually exclusive? Very good. Only we can go for a what? One project. Out of what? Multiple project. Out of multiple project, we can select only one project. Which project will be chosen? Which project will be chosen? So now, if you start the project A, 0.6 times what? 50,000. That would give you how much? 30,000. Clear? And 0.4 times 80,000, which would give you how much? 32,000. Therefore, total expected value is what? 62,000. Idea. If you are working with associated probability and the values, if you start the project A, 62,000 is your average profit. Is your what? Average profit. Is that understandable? After adjusting all the probabilities and the values, if you start the project A, which would give you the profit of how much? 62,000 as an average. That is what is known as expected value. And you have another option. That is what? Project what? B. Project B, 0.7 times 90,000. Then 63,000. Correct? Then 0.3 times 40,000 negative. Correct? That is how much? 12,000 negative. That would give you 51,000 expected value. So what we are looking here, we are balancing what? Risk and return. Trade between what? Risk and return. So if you start the project B, your average profit would be how much? 51,000 after adjusting what? Your probability. Now, based on the expected value, which project will be chosen? Yes, it's very clear. Risk neutral. Listen very carefully. Neutral. He will take the decision based on what? Expected value. Then he would say select project A. Expected value is higher than project what? B. Do you all agree with me? Do you all agree with me? That is all about what? Expected value. Now, if you look at a risk seeker, positive thinkers, optimistics, what he would say? He is not worried about what? Likelihood. What is meant by likelihood once again? Probability. Which project will be chosen? A or B? I need with evidence. B. Why? You can't look at the what? Percentages once again. That is what I said. They don't worry about the likelihood. They don't worry about the likelihood. Yes, that's correct. I can say that answer is correct. If you use a word of that 70%, then you are right. So he will take the decision, as I have clearly explained last time, max. His eyes will see only the amount, not the probability. His eyes, what will happen? He would say, if I start the project A, my profit is how much? 80,000. Correct? If I start project B, my profit is how much? 90,000. Therefore, 90,000 is bigger than what? 80. Taking the maximum amount from the what? Best out of best. What is meant by maxi max? Best out of best. A, what is the best? 80,000. B, what is the best? 90,000. The best out of best is what? B, which is what? 90,000. That is what is known as maxi max. Is that understandable? Is that understandable? Is that understandable? Last one, risk averse person. For the time being, we will use the word of what? Maxi mini. There are 4 techniques for him. One is maxi mini. Another one is what? Mini max what? Regret. Coefficients of variation. Another one is what? Standard deviation. Standard deviation. For the time being, let's apply what? Maxi mini. Let's apply what? Maxi mini. So how to work out for the maxi mini? Just have a look. Maxi mini. Don't forget, you will have to read in the reverse form. You'll have to read what? In the reverse form. You let it first read the mini. What is the minimum amount for the both project? Minimum amount for the both project. A's minimum amount is how much? 50,000. Once again, they are also not worried about the likelihood. They are not worried about the what? Likelihood. They focus only what? The numbers, amount. A, what is the lowest amount? 50,000. A lowest amount is, minimum amount is 50,000. What is the B's minimum amount? What is the B's minimum amount? Loss of what? 40,000. Loss of what? 40,000. Correct? You tell me, out of these two minimum, what is the maximum? 50,000 would be better because he's a risk averse person. He doesn't want to take risk. Pessimistic. He doesn't want to take a risk. So from the minimum, here select the what? Maximum. That is what? Project B. Sorry, A. No, I'm sorry. A. He will select what? Project A. Why? 50,000 is better than making what? 40,000 loss. Is that understandable? Is that understandable? Are you clear? So I have explained everything through a small example. What is meant by what? Risk neutral. What is meant by SICA? What is meant by averse? How to calculate expected value, right? What is all about what? Maxi mini. What is all about what? Mini max. Any questions? Any questions? Please make a note on that on your own English words. Once again, I'm telling you all, risk averse and the what? Taker. They are not worried about the what? Likelihood. They are not worried about what? Likelihood. Likelihood means what? Probability. They focus only on the what? Numbers. What is meant by maximax? Best out of best. What is meant by maximini? Worst. Out of the worst, what is the best? That is what? Maximini. Please take down this example and give the answers for all three types of a decision maker. Are you all done? Don't forget you are having exam on Friday, mock exam. Right, shall we move on to the next part? Next one is what? Payoff table. I hope you have got the questions. Right? Don't try. I'm going to explain the whole part through this question. You just have a look the question only. Just read the questions only. Payoff table. Table. What is meant by payoff table? That illustrates all possible profits and losses with associated probability. That is what is known as payoff table. Right? Just read the questions only. Through this payoff table, I'm going to explain expected value. I'm going to explain maxi max. I'm going to explain maxi mini. I'm going to explain mini max regret. And I'm going to explain VOPI, value of perfect informations. VOPI, value of perfect informations. Look at the question, what it says. Are you clear with the questions? I'm not expecting you the answers because I'm going to explain the whole part, because you know why this is one of the very important question. Why I'm telling all the professional as well as the degree program that they are providing, they are using for the payoff table this exam. Purify 1, ACCA, CIMA, CMA, any sort of a degree on the payoff table, they try to use what? This example, because this example which is giving the whole part of the explanation with regard to the payoff table. So one of the best examples, right? Jeffrey Ramsbottom runs a kitchen that provides food for various canteens throughout the large organizations. A particular salad is sold to the canteen for $10 and the cost is $8, then it's very clear you are making the contribution of profit is how much? $2. Do you agree with me? Do you agree with me? Right. Based upon the past demand, it is expected that during only 250-day working year, we do business only how many days? Out of 365 days, we do business only how many days? 250 days. Working year, the canteen will require the following daily quantities. 25 days, how many salad it will require? 50 days, how many salad it will require? 50, 60, and 70 salad for on 75 days. My first question, from before you read the rest of the part of the way and the questions, my first requirement, what is the risk this company is facing first? What is the risk? So you remember I have told you each business decision that you take, right? Or each business transaction situation that you face, you are dealing the hidden element of risk. What is the risk this company is having based on this information? I'm not expecting you to come up with about jargons. Very practical, very lamest. Very good, very close. But can you put it to the bigger picture? Very close. We are doing the business for 250 days. 25 days demand is what? 40 seller. Do you know what are those 20 days? Do you know what are those 25 days? Out of 250 days, 25 days demand is how much? 40 seller. But we don't know what are those 25 days. That is the risk that we are going to face. We know 50 days the seller demand is what? 50, but don't know what are those 50 days. As long as you knew in advance all Monday salad requirement is 50, then you will make 50 and you will sell 50. Do you agree with me? All Tuesday 40 salad, then what you would do? You know in advance there will be a demand for Tuesday 40 salad. Then each and every Tuesday, what you would do? You will make what 40 salad and you will sell it. But here the problem, the risk that are we going to face, we don't know the what market demand for each day separately, but we know overall 250 days there will be demand for 40 salad for 25 days. That is the risk that are we going to face. Let's quickly calculate the probability. How to calculate probability? Just have a look. Online student, are you all with me? Are you all with me? Only Sanjana. Sheba, thank you. Malavika, thank you. Navya, thank you. Nisho Joel, thank you. Only today I got more messages. Reply. Right, okay. Now, out of 250 days, right? 250 days, 25 days, the demand is 40 salad. That is the probability of how much? How many percent? 25 over 250, 10 percentage. Am I correct? 10 percentage or 0.1, 40 salad. Clear? So another 50 days, our demand is, then this should be 20%, which is 0.2 for 50 select. Is that understandable? Is that understandable? Next 100 days, sorry, 100 days out of 250, which is 2 times 40%, 0.4, 60 select. Is that understandable? Last one, 70 select, 75 days, which is what, 0.7, 0.3, 30% for 70 select. Are you clear? Are you clear? Right, okay. Now, that's a bit of a problem with what our demand and supply. Right? Let's take a one day. Let's talk about Monday. Let's talk about Monday. Monday, demand may be what? 40. Demand may be what? 50. Demand may be what? 60. Or demand may be what? 7. Don't know. That is unknown. That is a what? Risk. Demand may be any seller, any number of sellers. At the same time, supply also what? Any number. We may supply 40, we may supply what? 50, we may supply what? 60, we may supply what? 70. Now, you tell me where you have the control. Do you have the control on the supply or do you have a complete control on the demand? Think and tell me. Do you have the complete control on the demand or do you have a complete control on the supply? Where you have a control, where you can control. Only supply. We can have a control only on what? Supply. Therefore, our decision criteria, which should be based on what? Supply, not based on the what? Demand. Not because demand is out of our control. So, we can take a decision how many select we can what supply. We can't take the decision what would be the market demand. That of course out of our control. Do you agree with me? Is that understandable? Right? Now, based on the three types of a decision maker, right? Based on the three types of a decision maker, we are going to identify how many sellers that are we going to make and supply. Got my point? Am I clear to you? For that, I'm going to develop a table. I'm going to develop a table. Payoff table. Payoff table. Payoff table. One side I'm going to put the demand. Right? Demand can be 40. Demand can be what? 50. Demand can be what? 60. Or demand can be what? 70. Then I can put the probability. Probability. We have calculated. So 40 seller demand is what? 10%, 0.1. Agree with me? 50 what? 0.2. This is 0.4. This is what? 0.3. Don't take down now. First listen. I'll give you the time to take down. Right? This is the demand. On the other side, I'm going to put the word supply. Supply. I can supply 40. I can supply 50. I can supply what? 60. Or I can supply 70. Salad selling price is how much? 10. Salad cost is how much? 8. Every one salad, the company is making a profit of what? $2. Is that understandable? Right, okay. My first question. when the demand is 40, if you supply 40 salad, what would be your profit? 80. Why? Every salad you are making the profit of how much? $2. Since you have supplied 40 salad, then your profit is what? 80. Just randomly picking the student and I'm asking the question. Don't get me wrong, right? Don't get offended, right? When the demand is 50, you tell me first. When the demand is 50, you are going to supply 40 salad. What would be your profit? Your demand is 50, you are going to supply 40. Then what would be your profit? 80. Very good. Why? You can make a profit what you can supply only, not what is where the demand. Demand may be what? Any figures. Yes, next question goes to you. Demand is what? 60. Demand is 60. Your supply is 40. How much you can make a profit? Very good. 80. When the demand is 70, if you supply 40, then again your profit is what? 80. Is that understandable? Is that understandable? Next question goes to you. Very easy question. Because don't get me wrong, the online student, if I ask the question from you all, it take time to give me the answers, right? So I'm asking from the physical students. When the demand is 50, if you supply 50, what is your profit? Demand is 50, you are going to supply 50. What is your profit? It's very easy. If the demand is 50, supply 50, 100. When the demand is 60, if you supply 50, your profit is still 100. Why? You can make a profit, but you supplied only. Here also 100. Next question goes to you. Don't get me wrong. When the demand is 40, demand is only 40, but you are going to supply 50 seller. What is your profit? 80. Okay. Right, okay. But very close, but not close enough. Think bit. Sanjana, what is your answer? When the demand is 40, if you supply 50, what is your profit? From the girl side, anyone can answer. Question is open for everyone now. Demand is 40, but you're going to supply 50. What would be your profit? Correct. Why? $8. $8 is cost. Very good. Very good. Perfect answer. Perfect. I'll explain everyone. No worry. That is what I told you. In the exam also, you are very good. Don't be hurried to give the answer. You just think bit. Each and every question. Think bit and try to get the answer. Then you will be getting the correct answer. So what he is trying to say, when the demand is 40, your revenue, sales revenue would be 40 times 10, which is 400. Agree with me? But you made how many salad? 50 salad you made. So the total cost would be 50 times what? 8, which is how much? 400. Then no profit, no loss. If you supply 50 salad when the demand is what? 40. Is that understandable? But you don't tell me like this. I can put it in my refrigerator. Then I can sell it what? Tomorrow. We are doing the business where in Europe, not in Asia. So Asian continents, but not in India. But I'm telling you, some other countries, what they try to do is they try to keep it, but salad, no. They can keep it, but some places it's happening, right? So there will be a bit of a problem with the quality. Second thing is that is not ethical way of doing the business. Ethics is very important whenever you do a business. Do you all agree with me? There are some items. Illegally you can import and you can do a business. But you can maximize your profit. That is not an ethical way of earning a profit. So that's the reason in management accounting, I don't know whether you have done that part in the knowledge level, corporate governance and ethics. Ethics is very, very important, right? We'll have to always maximize our profit by doing our ethical way. So here you can maximize your profit by keeping your saladware in your refrigerator. You can maximize your profit. Still you can make profit. Correct? But here our assumption is what? That cannot be kept anywhere. In the day itself, it will get expired. Right? Okay. Now let's move on to the next one. When the demand is 60, if you supply 60, your profit is 120. Agree with me? When the demand is 70, if you supply 60, still your profit would be what? 120. You can make a profit only but you supply. Now you let me know. Sanjana, are you all okay? Arokya, are you all okay? Yes, Malavika. Thank you. Thank you. When the demand is 40, if you supply 60, what is your profit or loss? $80 loss. Well, how about others? When the demand is 40, if you supply 60. Calculate and check. When the demand is what 40, you are going to supply 60. Very good. Don't put the fictitious numbers way on the calculator. Just put the real number and get the answer. What's the answer? Guys who have given me the answers. Yes, very good, Malavika. Malavika also gave me the correct answer. When the demand is 40, your sales revenue would be 40 times what? 10, which is how much? 400. Correct? Your total cost, you made 60 salad at a rate of what? 8. 480 is your cost. Therefore, you will make a loss of how much? 80. Is that understandable? Is that understandable? Next one is what? When the demand is 50, if you supply 60. Sorry? 20 profit. Right, okay. When the demand is 50, your sales revenue would be 50 times 10, which is how much? 500. Your total cost would be, you made how many salad? 60. 60 times 8, which is how much? 480. Therefore, 20 you will make a what? Profit. Is that understandable? Last one. When the demand is 70, if you supply 70, your profit is 140. Agree with me? So all the other part you have to calculate one by one. When the demand is what 40, your sales revenue is what 40 times what 10 400, but you supply what 70, then the total cost would be 70 times 8, it is 560. Therefore, you will make a loss of how much? 160. So here the loss is how much? 160. Is that understandable? Is that understandable? Next one is when the demand is what 50. Sales revenue would be 50 times 10, 500. But you are going to supply total cost what 60. Sorry, 70. 70 times 8, 560. Therefore, still you will make a loss of how much? 60. Right? The last part. When the demand is 60, you are supplying what 70. Then the sales revenue would be 60 times 10, which is what? 600. Total cost would be 70 times 8, which is 560. You will make a profit of what? 40. This is the payoff table. Right? Is that understandable? Now, quickly let's calculate the what? You take down, will you first quickly all the informations? Are you all okay? Right. Now, shall I erase the, this part, working part? Now, let's quickly calculate the what expected value for each supply. When you supply 40, total expected value 0.1 times 80, 0.2 times 80, 0.4 times 80, 0.3 times 80. The total expected value would be here 80. Correct? Calculate the expected value when you supply 50. 0 times 0.1, 100 times, therefore it should be 90. Correct? Let me know the 60 and 70 because you'll have to deal with the negative numbers as well. How much when you supply 60 expected value? 80. Are you all backing the answers? 20 times 0.2, 120 times 0.4. Both we got 120. Yes, 120 times 0.3. Then 80 negative times 0.1. Malavika, Sanjana, what's the answer when you supply 60? It's 30. 30. Right, okay. For 60, I will get the same answer. It's not a rocket science, just calculate and see 0.2 times 20 plus 0.4 times 120, 0.3 times 120. And one more negative part is 0.1 times 80, which is what? 8. Right. That is the expected value for you can't take too much of time for that to get the answer for where in the exam. You have to complete in 1 minute for that one. 1 minute just putting into the calculator and addition subtraction. Clear? Right now. Let's take the decision for risk neutral. Risk neutral. He takes a decision based on what? Expected value. Do you agree with me? He would say supply how many salad? How many salad? Risk neutral. What is decision? Supplying how many salad? Because you can't have a control way on the demand. Your decision criterion would be what? Based on your supply. Risk neutral. He would suggest to supply how many salad? Very good, Malavika. 90 salad. Is there 90 salad over here? Supply 50 salad. He will ask you to supply what? 50 salad. If you supply 50 salad, you can make a average profit of how much? $90. Right? Next one is risk seeker. Max. Best out of what? Best. When you supply 40 salad, what is the maximum profit? 40 salad, what is the maximum profit? 80. If you supply 50 salad, what is your maximum profit? 100. If you supply 60 salad, what is the maximum profit? 120. If you supply 70 salad, what is the profit? So where you are getting more profit? Last one, max. Then he would say what? Supply 70 salad. DS, salads, plural. Clear? We call it as what? Max. Right. Last one, risk averse person. Averse. He can use the two techniques. One, we call it as what? Maxi mini. Another one is what? Minimax regret. So I will explain that part separately for this one. First, we'll quickly get the answer for the one. Maxi mini. How to work for maxi mini? Maxi mini. Take the minimum from each supply. When you supply 40, what is the minimum payoff? Minimum amount is what? 40. When you take supply 50 salad, what is the minimum payoff? Minimum amount 0. When you supply 60 salad, what is the minimum payoff? 80 loss. When you supply 70, what is the minimum payoff? 160 loss. Out of the whole minimum, you took the minimum. What is the maximum? What is the maximum? It comes from what? 40. 40 is the maximum out of the minimum. Alright, okay, I'm sorry. 80. Right? So out of the whole minimum, what is the maximum? $80. That comes from what? Supplying 40 salad. Therefore, maxi mini, he say what? Supply 40 salad. This is the working for that. Are you all done? Now I'm going to take you all to important part, mini max regret. If you do not understand properly, you will regret. Right? Therefore, please try to listen very carefully. Step by step, I'm going to explain to you. So that technique also, which is used by the what? Risk averse person. Right? Mini max regret. Right? So this is demand 40, 50, 60, 70. This is supply 40, 50, 60, 70. No, I'll put it properly because it's I don't have space, because without having a payoff table we can't get the what regret table. $40, $50, $60, $70. This is what supply. Right? You tell me. When the demand is 40, if you supply 40, will you regret? Will you regret? Right. Your regret is 0. Agree with me? When the demand is 50, if you supply 50, will you regret? Why? You can make a maximum profit. When the demand is 60, if you supply 60, you won't regret. You won't regret. When the demand is 70, if you supply 70, you won't regret. So this technique also for the risk averse person, don't forget. Mini max regret, which is used by the what? Risk averse person. Sometime you may get the contradict answer from the what maxi mini and the mini max regret. Then if you ask the question what is the best, both are best. Based on the management, they can take a decision whether to go for a what? A regret table or maxi mini. It's up to them. Right? Now, my question, when the demand is 40, if you supply 50, how much you would regret? Right, my questions. When the demand is 40, if you supply 40, how much the profit you can earn? When the demand is 40, if you supply 40, how much the profit that you can earn? $80. By supplying 50, how much the profit that you are making? 0. Therefore, if you supply 50, how much that you are going to regret? Once again, just have a look. When the demand is 40, if you supply 40, you can earn a profit of how much? 80. By supplying 50, you are making a profit or no loss is how much? 0. How much that you are sacrificing? How much that you are regretting? Very good, Sanjana. You could have earned a profit of 80, but you are making only 0. Am I correct? Therefore, you are regretting what? $80. Right? You tell me now. When the demand is what? 40. If you supply 60, how much you would regret? By supplying 60, how much you are making loss? $80 you are making loss. You could have earned a profit of how much? 80. Then what would be your total regret? Yes, very good, Sanjana. What would be your total regret? $160. Why? You could have made a profit of 80, but you are making loss of 80. All total regret is how much? 160. Because we are finding each supply how much that you are regretting. Are you clear? So now you tell me, when I'm asking from you, when the demand is what? 40, if you supply 70, how much that you will regret? Very good. 240. In the exam, I'll give you the hint. Take the highest value. What is the highest value from that particular row? 80. No, highest value 160 is but negative, no? No, that particular row horizontally, what is the highest amount? Horizontally. Not vertically, I'm asking. Horizontally. 80 is the highest amount. Take 80, deduct that 80 from each value. 80 minus 80 is how much? 0. 80 minus 0 is how much? 80 minus 80 is how much? 80 minus 160 is how much? In case if you forget the logic, you can get the answers by taking the highest value, deduct each element from there. You can get the answer. I can prove it to you through the next part itself. Right? Okay. When the demand is 50, but at the same time, you can't develop a regret table without having a payoff table. There should be a payoff table to get the what regret table. Otherwise, the regret table should have been given separately. Regret table should have been given what? Separately. Right? When the demand is 50, if you supply 50, you won't regret. Am I correct? When the demand is 50, if you supply 40, how much you regret? When the demand is 50, if you supply 50, you won't regret. If you supply 40, how much that you would regret? Very good. You would regret for what? 20. Because you could have made a profit of 100 by supplying 40. How much you are making a profit? 80. Then what would be your regret? 20. You tell me now, right? When the demand is 50, if you would have supplied 160, sorry, if you supply 60, what would be your regret? When the demand is what? 50, right? When you supply 60, how much that you would regret? 40. Excuse me. When the demand is 50, what is the best supply? When the market demand is 50, what is the best supply? Where you can earn a more profit? I'm not asking this question. I'm asking the practical question from you. Right? I'm not talking about the management accounting. You are doing a business. You know the demand is what 50 where in the market. What would be the best supply? 50. If the demand is 60, best supply is what? 60. You will not regret. Am I correct? That is the best supply. So when the demand is 50, if you supply 50, you won't regret. If you would have supplied but 60, you are making a profit only 20. Then how much that you are regretting? Otherwise, you will regret in the exam if you do not understand. No confuse. No, you could have made a profit of 100, no? But how much you are making a profit by supplying 60? You are making a profit of only 20. Then how much that you are regretting? How much you are losing? Sorry? Very good. That's all. It's not a rocket science. Right? Don't get me wrong. Don't get offended that I'm asking the question. I just want to make you all comfortable. That's why I'm asking the question. Right. When the demand is what? 50. You tell me. When the demand is 50. By supplying 70, how much you regret? Very good. Very good. Perfect answer. You could have made a profit of 100. Since you are making a loss is what? 60. Your total regret is how much? 160. Right. Go back to the shortest way of getting the answer. What is the highest amount for that particular row? 100. 100 minus 80 is how much? No, no. 100 is highest, no? Look at this row. Sorry? Yeah, that's what I'm asking from you. But we have completed. What is the highest amount on that? 100 minus 80 is how much? 20. 100 minus 100 is what? 0. 100 minus 20 is how much? 80. 100 minus 60 is how much? 160. Right. When the demand is 60, what is the best supply? 60. You won't regret. Do you agree with me? That's the reason I said what the regret is what? 0. Now you tell me. Yeah. Sure. When the demand is 60, right? If you supply 40, how much you would regret? When the demand is what 60, if you supply 40, how much you would regret? 80 is the amount you are earning by supplying 40. You could have earned a profit of how much? 120. Then what would be your regret? How much you are going to lose? No, no, not even the calculator. It's a very straightforward. Your maximum profit is 120 by supplying 60. 120. By supplying 40, your profit is only 80. Then how much you are regretting? How much you are forgo? How much you are sacrificing? Very good. Very good. Answer is correct. Can you explain her quickly? Right. Madam, you tell me. You tell me. When the demand is 60, I'm giving you the clue also. When the demand is 60, best supply is what 60, you won't regret. Maximum profit you can make as what 120. That is what we have got through the payoff table. Right? Now, by supplying 50, how much that you would regret? How much you would regret if you supply 50? From online, how much you would regret? Sorry? Yeah, yeah. That's yeah, correct. That's a hint. Easiest way of getting the answer. Huh? Yeah, you will be getting the perfect answer. There's no problem on it. How much? Yes. How much you would regret? If the demand is 60, if you supply 60, what is your profit? 120. If you supply 50, how much you are earning a profit? How much you are earning a profit when you supply 50? You are making a profit of 100. Then how much that you are regretting? 20. So you tell me the answer for the 70. If you, when the demand is what 60, if you supply 70, how much that you are going to regret? How much you are going to regret? 80. 80. Why? You could have made a profit of how much? 120. You are making profit only how much? 40. Therefore, your regret is how much? 80. So, just once again, horizontally take the highest value. Highest value is how much? 120. 120 minus 80 is what? 40. 120 minus 100 is what? 20. 120 minus 120 is what? 0. 120 minus 40 is what? 80. Clear? Now 70. When the demand is 70, if you supply 70, you won't regret. When the demand is 70, if you supply 40, what would be your regret? 60. You know why? You could have made a profit of 140, you are making only 80, therefore you will regret for 60. So for next one, very good, 40. Next one, 20. This is what we call regret table. Clear? Still we didn't answer for the question. We have developed the what? Regret table. We have developed the regret table. Just quickly take down the regret table, please. Yeah. Are you okay with the regret table? Oh, you have to go through again. Again, don't memorize. Don't memorize or don't use the what last point that I have given to get the answer, because that point that I have told you to get the answers behind the exam only. You can use, you can save the time and you can get the answers. But try to understand what's happening. Can you be here for 5 minutes? Is it okay for you? I can explain quickly the decision part. Right, I'll explain. Just have a look. Mini max regret. So this which would be done by the what? Risk averse person. So when you supply, what is the maximum regret? When you supply 40 salad, what would be your maximum regret? 60. When you supply 50 salad, what would be your maximum regret? 80. When you supply 60 salad, what would be the maximum regret? 160. When you supply 70, what would be the maximum regret? Right. We found the what maximum regret for each supply. From the maximum, as a risk averse person, he doesn't want to take what risk. He wants to find out the what where I'm getting the what lowest regret. From the maximum, lowest regret is coming from what 60. Supply 40 select. Is that understandable? Is that understandable? Right? From the each supply, you'll have to find out what is the maximum regret. From the maximum, you'll have to find out what is the minimum. Where you are going to get the what lowest regret. That's the reason most of the books they're taking this example. It's covering the whole part of what pay of paper. It's one of the best examples. Right, you can move. No problem. Only one part to be explained, that is what value of perfect information. I'll explain quickly. Which one? Which means the risk averse person, he doesn't want to take what risk. He doesn't want to take risk, right? When you supply 40, your total regret, you are going to worry. You are going to worry for what? $60. When you supply 50 salad, your total regret is how much? $80. Maximum regret. Maximum you will worry for 80. 60 maximum you will worry for 160. 70 maximum your regret is how much? 240. The risk averse person, he doesn't want to take risk. Where you are getting the what lowest what regret. Where he is getting the lowest regret? By supplying 47. That's why look at the name mini max regret. You have to read always in the reverse form maximum regret. We found the maximum regret. From the maximum, where we are getting the what lowest regret. Are you all with me, online students? Quickly take down. cursive writing, don't get me wrong, since it's not comfortable for me, it's height is not sufficient for me. I can't adjust. That's a maximum. Otherwise, I'll have to, that's why I'm just using like this. That's why it comes as a word cursive writing, each numbers. Last part. Small heading. There's a question from Sanjana. Does Maxi Minimax director suggest? No, not at all. Not at all, Sanjana. That is what I've said. There's a question from Sanjana. It's a very good question. Does Maxi and Minimax regret suggest the same decision every time? No, not at all. For this example, it has given you the same answer. Right? Minimax regret also, we got what 40 salad. Maxi also 40 salad. But some example, it may give you the contradict answer. Contradict answer. Right, let's talk about the last part of this, value of perfect information. Value of perfect informations. There's another one more part called value of imperfect information. That is not part of our discussion, right? We will calculate VOPI. I'll explain everything, no worries. What is exactly meant by value of perfect information? What is the amount that you are ready to pay for your researcher for their information? You can do a research, no? You can do a research with regard to what your demand. They may give you the research report. So if they are going to give you the research report, how much that you are ready to pay for their information, which is known as what? Value of perfect information. So what is that? The amount that we are going to get but extra would be the value of perfect information. How much that are we going to get but extra without information and with the information is what? Value of perfect information. Therefore, how to calculate VOPI? VOPI equal, just have a look, expected value with informations that is unknown yet. Right? Expected value. What is our expected value? Mean profit without information. Expected value with information minus expected value without information. Without information, already we calculated. Just have a look. Without any information, we said what? $90 is what? Our maximum profit. Do you agree with me? Without any information from anyone, we calculated ourselves. We can make a profit of how much? $90. Is that understandable? Therefore, this is what? $90. Now we are going to get the expected value with information. Right, okay. If we are going to get information from the fortuner or the researcher, when the demand is 40, correct? They will ask you to supply 40. They will give you the proper information. They are going to give you the information. We will supply 40. When the demand is 40, if you are going to supply 40, our profit is what? $80. Correct? The probability is what? 0.1, which is what? 8 EV. Is that understandable? Is that understandable? When the demand is 50, with their information, we will supply 50, correct? We will make a profit of how much? 100, correct? The probability is what? 0.2 we have calculated. That is what? $20. Is that understandable? When the demand is what? 60, we will supply what? 60. Then our profit is how much? 120. Probability is what? 0.4, which is how much? 48. When the demand is 70, we will supply 70. Then the profit is 140. Probability is 0.3. That would give you how much? 0.3, 30, 42. 42. Correct? Now, what is the total expected value with their information? 90, 110, 118. Correct? $118. So if we are going to get the information from the fortune or the researcher, we can make a profit of what? $118 per day. Correct? Without there any information, we can make a profit of what? $90 per day. Therefore, the value of their information would be $28 per day. Mac, it does not mean we are going to pay what $28 for them. We'll have to come to the conclusion to pay maximum is what 28, but better to pay what less than what $28. That is what is known as value of perfect informations. Is that understandable, everyone? Any problem, you can put them forward. I can clarify your doubts. No problem at all. Are you all done? Any question, please put them forward before we get started with the questions. So in the risk and uncertainty, we started with risk and what is meant by uncertainty. We talked about the expected value. Then we have covered the payoff table. Now there are two more subtopics to be covered. One is a decision tree. There's a small area which is what sensitivity analysis with what simulation. That's very straightforward. Sensitivity analysis, you don't have one in detail because the detail that you are going to discuss under APM, not here. Performance management, we have only the but small part of it with the risk and uncertainty. But most often that is applied for what? Investment appraisal, sensitivity analysis. Right now, let's get started with the past papers question. The question that is going to share is the sections B questions. I have removed only one question from there since we have not yet learned the sensitivity analysis. So you can try the first four questions, 1 to 4. Can give you another 5 to 6 minutes. Right, Sanjana has got the answers. She says first one is 450, second one is 960, third, yeah, fourth one is 191. Same answer. Very good. Malavika, have you got the same answer? 450, 960, and 191. Navya, Sheba, Srindi, 450, 960. Yes, correct, Malavika. Those two answers are correct. And get me the answer for the question number 4 as well, because that's talking about value of perfect informations. Shall I explain? How about you all? Shall I proceed? Okay. Milo runs a cafeteria situated on the ground floor of the large corporate office block. Each of the 5 floors of the buildings are occupied, and there are in total 1,240 employees. Those informations are not relevant, right? Milo sells lunches and snacks in the cafeteria. The lunch menu is freshly prepared each morning, and Milo has to decide how many meals to make each day. As the office block is located in the city center, there are several other places situated around the building where staff can buy their lunch. So the level of demand for lunches in the cafeteria is uncertain. Do you all agree with me? That is what? Uncertainty. We don't know that. Milo has analyzed daily sales over the previous 6 months and established a 4 possible demand level, their associated probability. He has produced the following payoff table to show the daily profits which could be earned from the lunch sales in the cafeteria. When the demand is 450, they have given. If you supply 450, the payoff table is given. So we don't need to prepare the payoff table. From the payoff table, we'll have to answer for the questions. First question, if Milo adopts Maxi Mini. What is meant by Maxi Mini? Get the minimum from each supply. From that, get the what? Maximum. This is for the risk averse person. Risk averse. Correct? Risk averse. Get the minimum. If you supply 40, what is the minimum? I'm sorry, 450. The minimum amount is how much? 1,170. Correct? If you supply 620 lunches, minimum is how much? 980. If you supply 775, what is the minimum amount? 810. Correct? If you supply 960, what is the minimum amount? 740. All the minimum, you found the minimum, correct? From the minimum, you'll have to read always in the reverse form. Minimum, what is the maximum? What is the maximum? 1,170. That comes from the what? 450 lunches. Do you agree with me? Do you agree with me? Very straightforward question, no? Very good. Question number 2. Question number 2. If Milo adopts a minimax regret approach to decision making, which daily supply level will be? So will he choose? Not will be. Will he choose? So now we have to develop a what? Regret table. Regret table. Sanjana, I don't know whether your answers are correct or wrong. See, you have got the 2 different answers for Maxi Mini and Minimax. It's not compulsory to what? Get the same answer, right? Now, I'm going to develop a regret table. Mini, Max, regret. Mini, Max what? Regret. Minimax regret. This is the what? The part where we are going to separate it. Therefore, we'll have to get the maximum regret for each supply. You don't have any control where in the demand. You have the complete control only where in the supply, right? So here 450. Here 620. Here 775. Here 960. This is what demand. Am I correct? Now let's get the word supply. Supply. Once again, 450, 620, 775, and what? 960. Correct? You tell me, when the demand is 40, if you supply 40, you won't regret. When the demand is 620, if you supply 620, you won't regret. When the demand is 775, if you supply 775, you won't regret. When the demand is 960, if you supply 960, you won't regret. When the demand is 450, if you would have supplied 450, you could have earned a profit of 1170. Am I correct? That is the maximum profit that you can earn. By supplying 620, you are making a profit of how much? 980 only. How much that you are regretting? 1170 minus 980. That would give you how much? 20, 190. 190. So here how much you are regretting? 1170 minus 810. 360. Next one. Let's talk about what 620. When the demand is 620, if you have supplied 620, you won't regret. Because you could have made a profit of how much? 1612. By supplying 450, you are making the profit as only how much? 1170. Therefore, how much that you are regretting? 442. Here, how much you are regretting? 1612 minus 1395. 217. Here, 320. 22. 90, 612 now. Yes, 322. You are correct. All the other answers are correct, no? Right. When the demand is 775, if you supply 775, you won't regret because you can make a profit of 2015. By supplying 450, you are making the profit only how much? 1170. How much that you are regretting? 345. 845. Here. Here. 230. Same answer. Backing, no? Right, okay. Last one. When the 960, if you supply 960, you won't be regretting. So by supplying 450, you will regret for how much? 1396. 26. Here. 80. 84. Here. 481. Are you all okay? The regret one? Online students, are you all okay with the regret table? Sometime when you are referring the answer from different sources, they would have given you in the different way, but don't go with that method. Try to go with the method that I have explained to you. It's easy for you to what? Get the answers where in the exam. Right? Now, we are going to find out the minimum regret from the maximum. Right? So, when you supply 450, what is the maximum regret? 1000. When you supply 620, what is the maximum regret? When you supply here 400, here what? 430. From the maximum, these are the maximum regret. Each supply, maximum regret. We'll have to find out what is the minimum. Out of the whole, the minimum regret come from that 430, which come from what? 960. Therefore, 960 lunches. Is that understandable? Anybody who have got the answer for the question number 3? Question number 3. Yeah, let's double check, right? Which of the following statement is true for true if Milo chooses to use the expected value to assist the decision making regarding the number of lunches to be provided. They're talking about what? Expected value. Am I correct? Expected value is a technique which is applied by the risk neutral persons. Correct? Milo would be considered to be taking a defensive and conservative approach. That is for whom? Risk averse person. Defensive and conservative approach, which is used by the what? Adverse person. Therefore, it's out because we don't use with the what? Expected value. Expected value will ignore any variability which could occur across the range of what? Possible outcome. That's correct. So variability that will be discussed not from the expected value, that is done through the what? Standard deviation and the coefficient of variations, right? Variability. Therefore, answer 2 is correct. 3, expected value will not take to the account of likelihood of the no, that is a part of what? Expected value. Likelihood is what? Much more important, probability. Expected value can be applied to Milo as he is evaluating the decision which occurs many times over. Yes, that's also correct. Therefore, what would be the correct answer? 2 and 4 would be the correct answer. 2 and 4 means what? B would be the correct answer. B would be the correct answer. Clear? Let's move on to the last questions. The Human Resource Department has offered to undertake some research to help the Milo to predict the number of employees who will require to lunch in the cafeteria each day. This information will allow Milo to prepare an accurate number of lunches for each day. What is the maximum amount which Milo would be willing to pay for these informations? How to calculate BOPI? Expected value with info. Without info. Without info is very easy. You have to get the what? Expected value for each supply. Are they given that? No, it's not. Then we'll have to calculate. So it will take time. 0.15 times 1170, right? 0. Therefore, each supply with information for 40, expected value would be how much? Sorry, 450. 450, 1170. Do you agree with me? Because the probabilities are what different, but the values are what same. Therefore, when you supply 450, you will be getting the total expected value 1170. When it comes to 620, what is the total expected value? 517.2. How to calculate? 980 times 0.15, 1612 times what? 0.3, 1612 times what? 0.4, 1612 times what? 0.15. That would give you what? 1570.2. When you supply 775, 148.25. Correct? When you supply 960, 1586.4. Now it's very clear where you are getting the highest expected value without any information. 775. That gives you how much? 1648.25. Correct? Now let's get work on what? With the information. With the information, it's very clear. I told you, if the demand is 450, no? Yes. You will supply how much? 450. Your profit is how much? 1170. What is the probability? 0.15. Correct? When the demand is what? 620, you will supply 620. Your profit is how much? 1612. The probability is how much? 0.3. When the demand is what? 775, you will supply what? 775. 2015. That would give you the probability of 0.4. Last one. When the demand is 960, you will supply 960. That gives you the profit of how much? 96. The probability is how much? 0.15. Now let me know the probability quickly here. How much? 105. Next one. Next. 806. Here. 70.4. Now we'll get the total expected value. How much? 1000? 8. 1839.5. So with the information, I'm sorry, I have put other way around. With the information, we are getting 1839.5. Without information, we are getting 1640.25. Then what is the value of perfect information?
191.
90?
191.25.
Yes, therefore nearest answer is what? A. Is that understandable? We'll have to do another one more 10 marks question tomorrow. With that, we will be doing a section C, one complicated question, 20 marks. Then we can get started with our decision tree, then sensitivity analysis. With tomorrow, we will be finishing the risk and uncertainty. This is, of course, little what, heavily tested part, right? Little bit of a what, the lengthy wise, the volume wise, it's very, high. You will be having what, little advanced questions. So there's a one question, recycle PLC. That is what we are going to discuss tomorrow. Even when you are reading the question itself, you'll get headache. Right? So that is, we are going to find out the, risk and uncertainty through the questions. Right? Okay. Anything that you want to ask from online? Online students, any questions before we wind up the sessions? Offline, are you all okay? Physical? Go home and redo the same questions again, but the better to do what that questions. Which one? Homework. There are a number of homework being given, but you all did not try at home. And in addition to that, some question being uploaded where in the your LMS, I believe, already with the tunes, with the study material. Also, I have uploaded some questions, each topic wise. That is a topic wise mock exam. But I don't know whether you all practice because I don't have a time to look into that part. So I just want to do some other questions as well. Shall we wind up the sessions if there are no any other questions? Thank you very much. See you tomorrow, same time. We will continue with the rest of the questions under risk and uncertainty.